Hello, this is Ina Y. Beroe, Secondary Mortgage Market, what you always wanted to know. So let's talk about hedging. We are going to discuss what hedging is, its basic principles, what's important, who can help you with this, and other related important considerations. Please finish listening to the training till the end because there will be some important things that I will be disclosing there. But before we dive in, this recording is for training and illustration purposes only and based on my experience and opinion. Your circumstances may require a different approach. So let's begin on hedging. So what is hedging and why do you want to engage in it? Various organizations, independent mortgage bankers, banks, mortgage bankers, um, originate mortgages and they lock the rate locks. And upon the expiration of the rate lock and closing of the loan, they sell these mortgages in secondary market. And that's kind of the definition of the activity of secondary market, right? Secondary marketing. They help loan officers and borrowers to rate lock the loan, and 30 to 60 days rate lock permitting, the loan will be processed, underwritten, and closed. And after that time, the loan will be sold in the market. However, as you can imagine, at the time of secondary marketing selling the loan, some time has passed, has gone by, and now the interest rate levels could be very different in capital markets. So let's say, for example, at the time when the rate lock was issued to the borrower for, let's say, a 30-year fixed rate mortgage, the rate was 6.5. And that's how secondary market rate locked and priced the loan and quoted the borrower. And now that organization has an obligation to the borrower for that rate. So they have to honor that rate. 60 days later, when the rate lock protection is over, and let's say 58 days later, the loan is closing and then is ready for sale, market could be at 7% at the time. So it could be, company could be exposed to severe losses if it did not have any hedging protection for that rate lock. So hedging is necessitated by the uncertainty of levels of interest rates up until sale to investor. So that uncertainty necessitates you as an organization engaging in hedging activity. Now, how does hedging exactly help with that? What I'm going to do right now is I'm going to share my screen with you. Okay. All right. And here is the example of what is hedge. So on day one, right, we have the rate locks. We have 1 million worth of rate locks that are created. Whatever that rate is, it's valued at par. Whatever that par rate is, that's where we locked the current market level. That's where we rate locked those locks. Then additionally, on day one, we put on 600,000 worth of hedge. That same exact day, same level of market is assumed, okay? Is also on at par, okay? And the reason why it's 600,000 and not 1 million is because we assume that only 60% of the rate locks that we just put on will close. because as you understand, rate lock, the borrower doesn't have the responsibility to close with you. They don't have an obligation. You have an obligation to close them at that rate, if they decide to close on that loan. However, the borrower does not have that obligation. So let's say 40% of the rate locks are gonna fall away. They're not going to close, but 60% of them are going to close. And that's why we're putting on a $600,000 hedge to protect ourselves for the sale of those resulting loans. Pull through is a completely separate, very complex and involved topic. And basically, it's probably the most important part of the hedging consideration. And I can create additional training on pull through and speak about the considerations that affect pull through. If that's of interest to you, please let me know and I will create that training for you. So moving on, we locked $1 million worth of rate locks at par, and we sold $600K worth of hedges at the current market also at par. And hedge here is we are selling mortgage-backed securities, MBS. Okay. So we assume here that our typical lock duration is about 60 days, and we need about 10 days to prepare the loan for delivery to the ultimate investor. So that gives us on day 70, we are now ready to sell those loans. We have 600K of loans as our assumption was accurate. And we are now selling it at 98 price because the market went down 2 points. So pause the tape right here. If you did not have any hedging, you would now lose 2 points on $600,000 because these loans are locked at par for you. So straight off the bat, selling those loans, you're losing 2 points. Now, however, we have a hedge. So on day 70, not only do we sell at 98 our $600,000 worth of loans, we also buy back $600,000 worth of hedge that we placed on day one at 98. So we buy it at 98, but remember, we sold it at par. So what happens is on day 70, you generate a loss of 2 points on the sale of your loans because you sold them at 98 and you originated them at par. And you make 2 points on your hedge because you sold it at par originally and you are now buying it at 98. Now, if you think about this here example and this scenario, regardless of what the market levels were at the time of lock, and regardless of what the market levels are now at the time of sale, that spread would hold, given two things. First thing is you estimated your pull through accurately and you did not buy or sell too much of a hedge, and that your hedge moves the same amount as your loans, meaning you have a perfect hedge. It's a perfect correlation. Where, side note, for mortgage loans, fixed rate 30-year mortgage loans, 30-year UMBS, Universal Mortgage Backed Security, would be a perfect hedge because it moves exactly the same amount as the loan pricing would move. So that's basically, here is the example of what the hedge would look like. Again, pull through is very important. Estimation of pull through is very important. It's probably you live with your pull through and you die with your pull through. If you did not estimate your pull through correctly, your hedging will not be protecting you correctly. So it's most important. Again, let me know if you would like me to do a recording on that. So there are quite a few of providers that can help you estimate the pull through, capture your pipeline, and help you hedge your mortgage lock pipeline. There are many in the market. I have my preferences. I won't be naming any names here. But just be careful when you're choosing your hedging provider because, garbage in, garbage out. If the person knows what they're doing, it will be great. And if they don't, you just have another person alongside you who doesn't know what they're doing, trying to help you. So just beware. Um, what typically the provider will do is overnight, or periodically several times a day, they will capture your mortgage origination of your rate locks. They will process them and give you a report of all the rate locks you have and all the rate locks you had coming in. They will show that alongside with all the outstanding trades you have that are protecting that pipeline of rate locks, and they will show you your daily exposure, and if you potentially need to be adding additional trades to be protecting yourself for an ongoing addition of rate locks. But also, rate locks could be expiring, so they'll kind of help you keep track of all that activity and help you with the hedging. You can do hedging yourself. They can do hedging for you. It really kind of depends on your needs. Again, there are quite a few providers to choose from. Some of them are really good. Some of them have shortcomings. So again, just be sure you are evaluating them properly. And this is basically now, we are done with kind of initial introduction of what hedging is, who engages in it, and how it helps you. So if there are any other topics, for example, pull through, or if you want me to discuss some of the providers that you would like to know about, please let me know in comments. And in closing, if you found this content helpful, please share it with others who may benefit from it. And until next time, and I will talk to you soon. Thank you.